When interest rates flip, the economy flips too. Historically, every time the inverted yield curve has appeared, financial markets have faced major turmoil. Let's start with the Volcker shock of the early 1980s. In the 1970s, the U.S. was struggling with sky-high inflation. To combat this, Federal Reserve Chairman Paul Volcker took drastic action. He raised interest rates to a staggering 20%, sending shock waves through the economy. The impact was immediate. Businesses struggled as borrowing costs soared, the stock market crashed, and unemployment surpassed 10%. The U.S. plunged into a deep recession from 1980 to 1982. Inflation was finally tamed, but the cost was brutal. Next, we have the 1989-1990 savings and loan S&L crisis and the Gulf War oil shock. During the low interest rate era, financial institutions recklessly expanded lending. However, the 1986 Tax Reform Act eliminated key real estate tax benefits, causing the market to cool rapidly. As a result, banks began collapsing, forcing the government to intervene with a $160 billion bailout. Then the Gulf War erupted in 1990, sending oil prices soaring due to supply concerns. Rising costs squeezed businesses, slowing economic growth. Consumer spending shrank, leading to a stock market downturn. The U.S. entered yet another recession from 1989 to 1990. The 2000 dot-com bubble followed soon after. The 1990s saw an explosion in tech and internet companies. If it has a com, it's a gold mine. Investors rushed in. Even startups with zero profits saw their stock prices skyrocket. At its peak, some companies had PE ratios over 100, a clear sign of excessive speculation. To cool things down, the Fed raised interest rates in 1999 and 2000. Then popped the bubble burst. The Nasdaq crashed 78%. Tech companies folded, unemployment rose. By 2001, the U.S. was in yet another recession. Then came the 2008 global financial crisis, one of the most devastating in history. Low interest rates had fueled a housing boom, but banks recklessly approved risky subprime mortgages. As the Fed raised rates, the housing bubble burst. The consequences were catastrophic. Lehman Brothers collapsed in 2008. S&P 500 plunged 57%. In 2019, the yield curve inverted, raising concerns about another downturn. The U.S.-China trade war had already slowed economic growth, and by late 2019, markets were volatile. Then in early 2020, COVID-19 hit. The global pandemic sent S&P 500 plunging 34% in March 2020. To stabilize the market, the Fed slashed rates to 0% and launched unlimited quantitative easing, QE. Fast forward to 2022-2023, and yet another banking crisis unfolded. To fight inflation, the Fed aggressively hiked interest rates. This triggered liquidity issues in banks, leading to the collapse of Silicon Valley Bank, SVB, and Credit Suisse, CS. As panic spread, small banks struggled and market volatility surged once again. So what does history tell us? Whenever the yield curve inverts, financial distress tends to follow within 1 to 2 years. The big question, will this time be different?